All right, welcome back to another Crypto Rolly tutorial. Today, this is going to be the most important tutorial to watch as far as trading. This is risk management, calculating your risk per trade, and using stop loss. Okay, guys? So for this example, we're going to use a portfolio size of $10,000 at current price. We're looking at 49.24 current price. Okay, guys? And generally, I like to use about a 1% risk per trade. That's 1% of my entire portfolio being risked on every trade. Now, if you're doing altcoin trades, you want to keep that risk probably lower per trade because we all know that the market moves together. So if Bitcoin rises, the altcoins rise. If Bitcoin dumps, the altcoins dump too. So, if you're using 1% risk on every single altcoin trade and you had 4 altcoin trades open and then the price dumps, all four of the altcoin trades dump on you, you just lost 4% on your portfolio. We don't want to risk that much. So if you're going to do multiple altcoin trades, you might want to consider even a 0.5% of a risk. So say you had 2 altcoin trades with a 0.5% risk on each, and they both dumped, you would only lose 1%. You see where I'm going with this? Maybe you had 4 altcoin trades, but each one was 0.5% risk per trade. You would only lose 2% on your portfolio if all 4 dropped. So if you're going to have lots of trades, you're going to want to make sure the risk per trade is smaller and smaller. Now, in general, we just look at 1%. If you want to be safe, under 1%, a little more risky, you could go up to 2%. Maybe you feel very confident or you're catching a momentum play. Maybe you go a little harder, okay? So anywhere between under 1% to about 2%, okay? Just a basic rule. Now, say your position size is $10,000. We have a risk per trade of 1% of the entire portfolio. Now, looking at like an altcoin trade, whether it's Ethereum, XRP, Tezos, this is where you buy, on a spot exchange, Binance, Coinbase, one of those. And let's say there was a 4% stop. And this is a 4% stop loss on the amount, on the price, okay? So there's a difference between, and I'll show you right here, I had it on Discord. There's a difference between risk per trade and percentage loss on price. The percentage loss on price would be the stop loss. Say Link, you bought in at $4.76 and your stop loss was $4.52. That would be a 5% stop loss, okay? So remember, difference between risk per trade and percentage loss on price, all right? So going back, we can see that, just an example, let's say there's a 4% loss on price and you wanted to risk 1% of your portfolio of $10,000. So $10,000 times a 1% risk equals $100, right? $100 divided by 4%, your stop loss, equals $5,000. This is how you calculate your position size. So say you had $10,000 and you wanted to enter a trade risking 1% of your portfolio with a 4% stop loss, you would put $5,000 on that position, okay? We can do another example. Let's say you have a $10,000 portfolio and you wanted to risk 2% and your stop loss was 15%. So on 2% risk per trade, you're willing to risk $200 on your portfolio, okay? So $200 divided by that 15% stop loss would give you $1,000, $333 position size. So if you wanted to risk 2% with the stop loss of 15% on that spot call, your position size will be $1,333, okay? So this is your general rule of thumb for calculating position size. Now let's say you're on margin, which I often am. Now sometimes you won't have enough time to, look at the stop loss and do all this calculations, but you want to know in general terms how much you're willing to risk on each trade, okay? So if you had a $10,000 portfolio at BTC price of $49.50, right? So at current price, you had $10,000 USD worth of Bitcoin. That would be about 2 Bitcoin, right? And you're willing to risk 1%. So you're willing to risk $100 on each trade, okay? $100 is 1% of your $10,000 portfolio. So then you would divide $100 by the current price is $49.50. That gives you 0.02 Bitcoin risk per trade. So basically, before you enter the trade, you're willing to risk about 0.02 Bitcoin on any given trade. You just know that off top. So basically, you'll get accustomed to it and become more comfortable. But when you first enter your trades, you definitely want to use on the BitMEX, you have a calculator that you can use. On Bybit, they have a great feature where you can automatically enter your stop as you're entering the trade. It will calculate, how much risk you have before you enter the trade. Great option there. So basically, you will want to know your contract size. Let's say that your normal contract size, with a normal type of stop loss where you're risking 1%, let's say it's 1,000 contracts on margin. Okay, so in general, just the general type of stop loss method I use or you use will end up losing you about 1% or 0.02. So 1,000 contracts would be your position size on margin. So you want to consistently use the same amount of contracts. So let's say you're unsure and you just kind of want to put in a tiny little bid just to get your feet wet. Maybe you put in 500 contracts. Your normal size is 1,000 contracts. So maybe you just want to put in half of that just to test the waters. And you put in 500 contracts, okay? And maybe you get a little more confident and you can add on to that position, bringing yourself to 1,000. But if you go up to 2,000 contracts, you just doubled your size. So my point is, use this method, calculate your risk per trade, calculate position size, and become accustomed to how much you are entering on each trade so that you can enter fast without having to do all the calculations. You do need to do the calculations after you've put in the trade, but this way you can act fast. And knowing, okay, for example, I generally place $1,000 on each, 1,000 contracts on each trade. So I'm just going to enter it in with my consistent amount. If I'm being safe, I'll do half of that amount. If I'm being risky, I would do double. But just have that idea, okay? So my point here is, this is how you calculate your position size, understanding the difference between risk per trade and what did we say here? Let's go back to Discord. The percentage loss on price. Percentage loss on price is the stop loss percentage. Risk per trade is how much you're risking of your portfolio. Okay? I hope this is clear. Screenshot this if you need to. You can go back. Say you have a $20,000 portfolio. Then calculate using these numbers, okay? Say you have a $1,000 portfolio. Calculate using these numbers. If you have a $1,000 portfolio, that means you're only willing to risk $10 on each trade. This type of method will keep things consistent. This will keep things steady. If you are doubling your account in the matter of a week or two, you are gambling, okay? You want a slow, steady increase of profits. That is the correct way to trade. Because yes, you may be able to get crazy and double up your, you just throw a heavy amount on a trade, you make a big trade, amazing. But the problem is it's going to bite you in the ass down the road, okay? A good analogy is if you're playing Russian roulette, you put one bullet in a chamber of a potential 6. You pull that trigger, you don't die. Does that mean it was a good idea? You see what I'm saying here? Yeah, maybe you made heavy profit on that one super risky trade you took that day. Congratulations. However, if you repeat that process, you will get burned, and you will get burned badly. And if you don't keep a consistent strategy, you could say you're doing this consistent strategy for a whole month, and you just building your portfolio consistent for an entire month. And then one day you get emotional and you go all in, and it just happens to be the wrong trade to go all in on. All of a sudden, you weren't following your method and your strategy, and you just lose all of that profit. You can lose all of the profit of a month of hard work in one trade. So this is why you have to know how much you're willing to risk on each trade and how much you're willing to place on each trade. Okay? So I think that's a good summary there. Now let's go over to another chart, and I'll show you how I look at stop losses. Okay? So we'll go over to our BitMEX chart. Okay? So we'll go over to a 4-hour time frame, and we'll just come over here. Okay? We'll look at previous price action. So basically, when you're trading, this is a good example. We had a nice rally up. When you enter a trade, you want to, and say we're going to go long. Say we took a long right here. Okay? You're going to want to put your stop loss below this swing low. Okay? Because right here you have, swing high, swing low, swing high, swing low, swing high, swing low. This is the pattern. Obviously, when you're here, you don't know what's going to happen here. But if this pattern is to stay consistent, you want to put, higher lows, higher highs on a long. You're going to want to put your stop loss beneath this swing low. Okay? That would be an example. Now, say you were shorting and you didn't know that it was going to pump, but you just really believed that we were going to go down. And maybe we were. How would you know at this time right here? You would put your stop loss above the swing high. So general rule of thumb, okay? In this situation, maybe your swing low is way too far away for a stop. So then maybe you would look for where the previous price was trading. You would put it beneath that. Basically, you're looking for areas of support and resistance. So if I'm trading here, I know that this was a support level. I know down here would be pretty safe, but maybe that stop loss would be a pretty big loss, okay? So then maybe I would consider an area of previous trading, and I could see the previous trading here, so I'd put my stop loss in here. Now, say I was here and I wanted to short going down. I would probably put my stop loss above here, okay? So you want to put on a short, you want to put your stop loss above resistance. On a long, you want to put your stop loss below support, okay? The wider your stop, the better chance you have, but maybe the more you're risking. So the larger the stop, the smaller the position size you can put on it, okay? If you put $1,000 here and you have a pretty tight stop loss, you will lose X amount. But $1,000 here with the stop loss with there will be a significantly greater loss. So you might want to consider, say you did want to put your stop here, maybe only putting $500 instead of $1,000. Just because you have a larger stop, you need to accommodate for that, okay? Tighter stop, you can put a heavier amount, but just know it's risky. Another method to do this on is using the actual candle bodies or the top of the wicks. So I would say, a 4-hour candle minimum would be something you want to look at. So if you say took a short in here, you would want to put your stop loss above this 4-hour candle. If you were taking a short here, you would want to put your stop loss above this 4-hour candle. If you were taking a long here, you want to put it beneath, taking a long, put your stop loss beneath this 4-hour candle. So you would look at the top and bottom of the current or the previous 4-hour candles to decide where your stop goes. If you want to be more safe, you could go to a 12-hour or you could go to a daily, depending on what type of trader you are, okay? So say you were bullish right here and you took a long, you would put your stop loss beneath this daily candle. And had you taken a long here and your stop loss was beneath this daily candle, you can see how we just continued to rise. This candle never dipped beneath this daily, never dipped below, never dipped below, never dipped below. Here you finally got wicked out, okay? If you were just trailing beneath each daily candle. But then again, each one is higher than the next. So when it's a trending move, you will notice that the next candle won't go beneath the previous candle. So you put your stop loss beneath the previous candle. 4 hours pretty, tight and maybe more risky. 12-hour less risky, daily less risky. If you are a real swing trader, you could even look at the weekly, okay? What's happening here? Wow, I don't know where this price went, how we went all the way back here. All right, guys, at least I got most of this video done. So, but basically what I'm saying, looking at the weekly, and say you thought we were at a top here, you could have put your stop above this weekly. Then you can move your stop to if you're shorting, move your stop to this weekly, move your stop, move your stop. If you were longing this, you could have put your stop down here, then here, then here, then here, then there. So you want to trail the candles. If you are following like a very significant dump, you might even go down to a 15-minute candles just to trail it, just to take that profit, okay? So basically that is a basic, just general way of using stop losses. And I hope that, following my types of trades and seeing where I'm placing my stop losses, it will start to click. And you'll start to get that idea of why I'm choosing the places that I'm choosing for my stops. Okay? Very important video. Go back, watch this again. Watch this again in a couple months. Okay? You need to know risk management and proper stop losses. It's been Crypto Rolly. We'll see you in the VIP.